The most powerful banker in the world just broke his silence on a threat that could wipe out trillions in wealth. What he revealed wasn't a gentle caution, but a specific, terrifying probability. And the reason he's speaking up now will change how you see the entire market. Jamie Dimon runs the biggest financial institution in the United States. In a recent interview, he said something he has never dared to state publicly. He believes there is a 1 in 3 chance of a major market collapse unfolding within a very narrow window. Not the minor correction most traders expect, but a full-scale crash. Then, on a separate earnings call, he used a phrase that sent a chill through seasoned analysts. He said, "When you spot one bug, you can be sure there are others hidden." He's referring to the early corporate failures now appearing, the fissures in our financial foundation, the very same signals he observed back in 2008. Consider what that means. This is Jamie Dimon. He navigated the 2008 meltdown while legendary firms like Lehman Brothers crumbled. He has steered his bank through every economic storm since the turn of the millennium. He is not an alarmist. He doesn't deal in wild predictions. For him to go on international television and issue this warning means something significant is brewing behind the curtain. He sat down and stated he is substantially more concerned than his peers about an impending market shift. The indexes had just notched their 33rd record high of the year. Everyone was cheering. Yet Dimon was running numbers that should frighten any attentive observer. He said the odds of a crash aren't the mild 10% factored into most models. They are 30%, 3 times higher. And he gave a time frame. As soon as 6 months from now, was stretching out 2 years. But here is the truly alarming part. Just over a week later, JP Morgan hosted its quarterly earnings call. Analysts inquired about some sour loans the bank had to write down. Dimon could have offered a bland corporate reply about standard risk procedures. Instead, he said this: "When you spot one bug, you can be sure there are others hidden." That isn't financial jargon. That is a deliberate, stark warning. The bug he mentioned was a Texas company named Triton Holdings that filed for bankruptcy. You likely haven't heard of them, but they matter. Triton focused on subprime auto lending, providing credit to borrowers with poor credit histories. Think of them as the modern equivalent of the subprime mortgage originators that sparked the last crisis. Identical model, different collateral. They bundle risky debts, sell them to investors chasing yield, and collect fees while the risk permeates the entire system like a toxin. When Triton failed, it cost JP Morgan around $170 million. For a bank of that size, it's a rounding error. But the money isn't the point. It's the symbolism. Because just 1 month prior, another subprime auto lender, Premier Auto Credit, also went under. Same high-risk lending, same collapse. That's 2 bugs Dimon has already seen. And if you understand pests, you know they are never alone. So what do you imagine happens when the CEO of the nation's biggest bank goes on television and likens current bankruptcies to an infestation? You'd expect panic, right? You'd think investors would get nervous, maybe sell some holdings, adopt a more cautious stance. But the actual result was nothing. The market kept climbing. Tech stocks kept soaring. The celebration continued unabated, and that complacency is precisely what worries Dimon. He's witnessed this story before. Complacency is the kindling for financial fires. In his interview, he specifically pointed to artificial intelligence company valuations as being in a bubble. A recent central bank report from England noted that AI stock prices appear overinflated and carry the danger of a sudden, sharp drop. Translation: the institutional money believes AI firms are dramatically overpriced. And when the hype fades, the fall will be severe. Yet everyday investors, the people putting their savings into these stocks, are ignoring the alerts. They're too captivated by their rising account balances. Here's a statistic that demands your focus. The 10 largest firms in the S&P 500 now account for 40% of the total index S value. That is an unprecedented level of concentration. It means our stock market has never relied more heavily on a tiny group of tech titans, most of them surfing the AI wave. If those 10 companies falter, the entire market goes down with them. It's like constructing a skyscraper where 40% of the support relies on just 10 pillars. It seems solid in calm weather, but what occurs when one of those pillars begins to splinter? Dimon knows the answer. He saw it in 2008 when subprime mortgage firms began failing in sequence. He watched as the early bankruptcies were dismissed as isolated events. Then the contagion spread. Then the panic erupted. Then Lehman fell. and the world's financial arteries clogged for 3 days, while governments race to avert total disaster. That is why his bug comment is so critical. He isn't casually noting a few bad loans. He is telling you, in the clearest language a banking chief can use without triggering outright chaos, that the current landscape looks exactly like the initial phase of 2008. Minor failures in risky lending, speculative mania in a trendy sector, record high markets while the groundwork shows cracks. And just like then, everyone is dismissing the signals because profits feel too good to question. You must comprehend something about Jamie Dimon. This man does not speak recklessly. When he draws a comparison between our situation and an infestation, he is leveraging 38 years of experience steering through financial hurricanes. He endured the 1987 crash. He witnessed the long-term capital management debacle. He lived through the DOT combust. He didn't just survive 2008. He leveraged it to strengthen his bank, acquiring Bear Stearns for a pittance when rivals were drowning. If there is one person in American finance who recognizes the embryonic stages of a crisis, it is him. So when this individual with this specific track record goes on global television and states there is a 30% likelihood of a crash in the next 6 months to 2 years, you should probably listen. Because unlike us, he can observe the data the market doesn't display. He knows which corporations are straining under their debt. He sees which industries are trembling. He possesses information that won't become public knowledge until it's too late to react. The stock market celebrated 33 record highs while Dimon was raising red flags. That divergence should tell you everything about our position in this cycle. The festivities continue, the music still plays, and everyone is having a wonderful time. But the man who has attended this party before is standing near the door, observing the crowd intently and softly hinting that you might want to locate the nearest exit. Because in his view, when you spot one bug, there are invariably more concealed in the shadows. And the longer they remain hidden, the more catastrophic it becomes when they all emerge simultaneously. The biggest crashes always start with the smallest. What you must grasp about financial collapses is that they always begin on a small scale. One company goes under, the market shrugs, calling it an isolated incident. Then another fails. Still isolated, they claim. Then several more collapse. Then panic, then systemic failure. This sequence has recurred so frequently in economic history, it's almost predictable. And Jamie Dimon has lived through each of these cycles since 1987. Let us examine the crisis Dimon understands best because he didn't just endure it, he used it to gain power. March 2007. A firm called New Century Financial declared bankruptcy. If you weren't deeply engaged with finance, then you probably missed it. New Century was a subprime mortgage lender. They specialized in loans to people who could unqualify for standard mortgage with weak credit and unsteady incomes. Sound familiar? It should, because it's exactly what Triton Holdings was doing with car loans before its September failure. When New Century collapsed, the financial press covered it for 2 days and moved on. Experts appeared on TV and uttered the usual lines. This is an isolated incident. Housing fundamentals are strong. No systemic risk here. Jamie Dimon read those reports and trusted none of it. 3 months later, in June 2007, 2 Bear Stearns hedge funds packed with subprime mortgage investments imploded. Again, the market treated it as an isolated issue. One bank's bad quarter. Nothing to see. Keep buying stocks. But Dimon was watching the pattern form. He knew what was coming. What came next was over a year of small failures that everyone kept calling isolated, right up until September 2008 when Lehman Brothers failed and the global financial system seized completely. Banks refused to lend to one another. Credit markets froze. The market plummeted. A $700 billion taxpayer rescue was needed to stop a meltdown that would have dwarfed the Great Depression. But here's the crucial part. JP Morgan didn't just survive. They prospered. In March 2008, with Bear Stearns near failure, the Fed arranged for JP Morgan to purchase them for $2 per share. $2 for a company valued at $70 per share just half a year earlier. Dimon secured the deal of a lifetime because he had prepared for the storm, while others pretended it was unit coming. He had constructed a fortress balance sheet, hoarding cash and sidestepping the riskiest assets while competitors feasted on subprime fees. That is why his bug remark in late 2025 should alarm you. He is using the identical language he used inside JP Morgan in 2007. When you spot one bug, you can be sure there are others hidden. He's telling you, In the most explicit terms a bank CEO can muster, that the present situation with subprime auto lenders mirrors what happened with subprime mortgage lenders 18 years ago. But let's look further back. September 1998, a hedge fund named Long-Term Capital Management collapsed. This wasn't a shady operation. It was run by Nobel laureates, genuine geniuses with economics PhDs. They constructed intricate computer models designed to eliminate risk through complex hedges. The brightest minds in finance operated this fund, and they lost $4.6 billion in 4 months. How? Russia defaulted on its debt, an event their models hadn't considered. Their risk-free strategy proved disastrous when the unexpected occurred. The Federal Reserve had to organize a $3.6 billion bailout from 14 major banks because LTCM was so intertwined with the system that its failure threatened a worldwide crisis. And once more, everyone said it was an isolated incident. Just one hedge fund that got too smart. Nothing systemic to fear, except it wasn't isolated. The Asian financial crisis was raging. Nations were defaulting. Markets were unstable. LTCM was merely the visible bug. Many more lurked in the plumbing of international banking. The lesson from 1998 is clear. When the smartest people tell you they've abolished risk with complex models, be skeptical. Risk never vanishes. It just hides where you aren't looking until an unforeseen event triggers an explosion. Now, let's discuss a pattern that should feel very familiar if you've watched artificial intelligence stocks lately. March 2000, the Nasdaq index peaked above 5,000 points. Internet firms that had never earned $1 of profit traded at 1 to 200 times their revenue, not earnings. Revenue because most had no earnings. But it didn't matter. Everyone chanted. This time is different. The internet changes everything. Old valuation rules don't apply. The ending between March 2000 and October 2002, the Nasdaq fell 78%. $5 trillion in market value disappeared. Companies once worth billions became worthless. The new paradigm was the same old story. When valuations detach from reality, gravity always returns. Jamie Dimon was at a major bank during the dot-com crash, watching the euphoria turn to terror. He saw retail investors who borrowed against their homes to buy tech stocks lose everything. And now, when he observes AI stocks trading at 50 to 100 times earnings, when he reads the Bank of England's warning about inflated AI valuations and the risk of a sharp correction, he's watching the same film with a new cast. The pattern repeats because human psychology is constant. Greed, fear, euphoria, panic, these are fixed. The assets change, the tech advances, but the cycle remains. In the late 1990s, it was internet stocks. In the mid-2000s, it was real estate. In 2025, it's artificial intelligence. Each time, the mantra is this time is different. Each time, they are wrong. Let me take you back even further to show how suddenly these collapses can strike. October 19th, 1987. Black Monday. The Dow Jones crashed 22.6% in one day. Not over weeks, one day. The largest single-day percentage drop ever. People awoke with retirement savings. By bedtime, a quarter of their wealth was gone. The cause? Portfolio insurance. It was a new 1980s strategy where computers would auto-sell stocks during declines, theoretically shielding investors. The flaw was that everyone used the same strategy. When selling started, it triggered more automated selling, creating a cascade that overwhelmed the market. It's identical to what we see today with AI-driven trading algorithms. When everyone uses the same models, when everyone makes the same bets, the exit becomes impossibly narrow very fast. Dimon was on Wall Street in 1987. He felt what it's like when a seemingly invincible market collapses without warning. The lesson from Black Monday is that crashes aren't always gradual. Sometimes they happen in hours. If you're unprepared, if you're fully invested when it hits, there is no time to react. Now, let's connect all this to the present. Triton Holdings failed in September. Premier Auto Credit failed around the same time. Both subprime auto lenders, both following the precise model that destroyed New Century Financial in 2007, both exemplify the kind of reckless lending that infects the financial system when times are good and yield is scarce. These are the Bugs Dimon references. But it's not just auto loans. Look at the broader picture. The top 10 S&P 500 companies constitute 40% of the index, more concentrated than at the 2000 dot-com peak. AI stocks have valuations that make the tech bubble seem reasonable. Nvidia, Microsoft, Google, Amazon, their market caps assume they'll maintain enormous growth for decades. Perhaps they will. But what if they don't? What if AI is transformative, but not as profitable as expected? What if the billions spent on AI infrastructure don't generate the projected returns? What if competition crushes margins? What if regulation restricts use? These are the questions Jamie Dimon is asking, while everyone else buys the hype. Financial crises always start small. New Century Financial in March 2007 seemed like one bad firm. By September 2008, it was a global catastrophe. LTCM in September 1998 seemed like one over-leveraged fund. It became a multi-billion-dollar rescue and a preview of wider troubles. The dot-com crash began with a few struggling internet companies in late 1999. By 2002, the entire tech sector was devastated. The mechanism is always identical. Minor failures are dismissed as isolated. The market keeps rising because most don't see or don't want to see the problem. Then more failures happen. Still isolated. They insist. Right up until the moment it's obvious nothing was isolated. Everything was connected, and the whole system is in jeopardy. By then, it's too late. The exits are blocked. Panic has set in. The crash. Jamie Dimon has seen this pattern 5 times. 1987, 1998, 2000, 2008, and the 2020 COVID crash. Each time, there were warnings most ignored. Each time, those who heeded the signals survived, while others were devastated. And now, he is waving the largest red flag of his career. When he tells a major network the crash probability is 30%, he isn't guessing. He's calculating based on everything he sees inside the banking system that you and I cannot. When he says bugs on an earnings call, he is using language specifically crafted to make investors recall 2008 without saying this is 2008 again and causing a stampede. The historical pattern is clear. It has repeated over and over. Small failures precede large ones. Euphoria precedes panic. Bubble valuations precede crashes. And the individuals who recognize the pattern early, who prepare while others celebrate, are those who not only survive but emerge stronger. Dimon survived every crash since 1987 because he identifies this pattern. He knows the early stages. He knows how swiftly isolated incidents become systemic crises. And he knows that by the time it's obvious to all, it's too late to act. That is why he warns us now, while the market still hits records, while others still profit. While worrying about a crash still seems irrational. Because in his experience, when you spot one bug, there are always more lurking in the darkness. And the longer they stay hidden, the larger the invasion grows. So the question you should ask is this. If Jamie Dimon has witnessed this pattern 5 times before and is sounding the alarm now, what is he seeing in the current climate that could make this worse than 2008? Let us begin with something that did exist in 2008. Severe geopolitical instability on several fronts at once. In his interview, Dimon specifically pointed to the conflict in Ukraine, turmoil in the Middle East, and mounting friction between China and Taiwan as major elements in his crash calculation. These aren't just distant news stories. Each of these conflicts is actively destabilizing the global financial system right now. Consider what war does. It shreds supply chains. It inflates energy costs. It pushes governments to spend non-existent money on military expansion instead of productive investment. And most of all, it creates profound uncertainty. Markets despise uncertainty. When investors cannot predict the next month or year, they sell first and investigate later. We are in the most geopolitically volatile period since the Cold War. That instability is a tinderbox beneath our stock market. Then there's the government debt problem. The U.S. carries over $38 trillion in debt. Our government runs annual deficits of $2 trillion. Let me frame that. We borrow $2 trillion each year just to maintain operations. And that's during supposedly strong economic conditions. What happens when a crisis strikes and the government needs to spend trillions more on bailouts, like in 2008? Where does that money originate? Here's what Dimon knows that most aren't considering. Every major crisis in the last 3 decades was solved by the government intervening with massive spending. The 2008 bailout was $700 billion. The COVID response was over $2 trillion. But we are already so indebted that the next bailout might shatter the government's capacity to borrow. And if the government cannot borrow to fix the crisis, if we've maxed out the national credit line, then what? That is the scenario that haunts Jamie Dimon's nights. Add to this the global rearmament happening now. Europe is rearming due to Russia. China is bolstering its military. The US is boosting defense budgets. All that capital trillions globally is being siphoned from productive economic uses into weapons and military infrastructure. That is money not flowing into businesses, tech, innovation, or anything that fosters growth. It's simply consumed in an arms race that impoverishes everyone except defense firms. Now, layer on top of all this chaos the AI bubble Dimon explicitly highlighted. Remember, the top 10 S&P 500 companies are 40% of the index. Most are tech firms riding the AI wave. Microsoft, Nvidia, Google, Amazon, Meta. Their valuations assume AI will transform everything and they'll capture huge profits. But what if the AI revolution is real but not as profitable as stock prices imply? What if building this AI infrastructure costs far more than the revenue it produces? What if competition evaporates margins? According to the Bank of England, AI stock valuations seem inflated and carry significant risk of a sharp correction. That's central bank code for this is a bubble waiting to burst. Here is the terrifying part. Those 10 companies are 40% of the index. If they crash, the whole market crashes with them. Your retirement account, even if you think it's diversified across hundreds of stocks, is actually 40% weighted toward 10 companies betting on one technological trend. If that trend reverses, if AI disappoints, if valuations normalize, your portfolio loses 40% of its value before you can blink. And recall those bugs we discussed. Triton and Primerato weren't flukes. They are symptoms of a much larger consumer debt bubble. Subprime auto lending is one piece of a massive consumer credit bubble. Federal Reserve data shows Americans carry record credit card debt, auto loans, and student loans. Delinquency rates are rising across the board. These are the same early warnings that appeared in 2006-2007 with subprime mortgages, except now the debt is spread across different consumer lending categories. When Dimon raised his crash probability from 10% to 30%, he was running numbers that incorporate all these variables: geopolitical instability, unsustainable government debt, global arms race, AI bubble, consumer debt crisis, concentrated stock market. Anyone would be worrying. All happening together is why he uses words like bugs and gives specific crash time. But here's what you truly need to understand. Jamie Dimon isn't warning you because he fears for his bank. JP Morgan will be fine. In fact, JP Morgan will excel. They do exactly what they did in 2008. They used their fortress balance sheet to purchase failing competitors for pennies. They'll exit the crises larger and more dominant. Dimon has been through this cycle enough to know that crashes create chances for prepared institutions. The people who won't be fine are the retail investors all in on AI stocks at bubble prices. The people with subprime auto loans they can't afford nearing default. The people who assume the market only goes up because that's all they've known recently. The people who didn't listen when the man who survived every crash since 1987 told them there's a 30% chance this unravels in the next 6 months to 2 years. Think about his timeline again, starting in just a few months, stretching too late 2027. He isn't saying it's certain. He's saying there's a 1 in 3 chance, which in finance is massive. If someone said there was a 30% chance your home would burn down in 2 years, you'd buy insurance instantly. But because this is the stock market, because stocks rose yesterday and will likely rise tomorrow, most will ignore the warning entirely. Jamie Dimon survived 2008 because he spotted the pattern early. In March 2007, when New Century failed, he knew more would follow. He fortified JP Morgan's balance sheet. He hoarded cash. He avoided the riskiest assets. And when Bear Stearns collapsed in March 2008, drowning in subprime losses, he bought them for $2 per share in a Fed-brokered deal. He turned crises into historic opportunity. Now, he's using the same language: bugs, failing subprime loans, bubble valuations, geopolitical chaos. He told a major network the crash odds are 30%, not 10%. He said it could happen in 6 months to 2 years. The market celebrated 33 records while he issued this alert. The party continues. Everyone is still making money. The music still plays. But this isn't a retired executive making predictions to sell books. This is the man running America's largest bank through 2 decades of crises. This is the insider with data you'll never see. Who knows which loans are souring? Who can read the financial system's patterns before they're obvious to everyone else? When someone with his record and his position goes on global television and warns about bugs, you should pay close attention. Because history teaches us one thing above all: the biggest crashes always seem impossible. Right up until the moment they begin. If you found this perspective valuable, please support this channel by hitting the like button and make sure to subscribe to Winds of Thought for more clear-eyed analyses.